subscribe now and press the bell icon. Never miss an update.
Let's get started. Unit 11, Chapter 11, it's based on, I think, two major things. I'm not able to recall the next topic, but the first one is sale of principal residence. Oh yeah, the second one is like-kind exchanges. We'll see what is like-kind exchange. How can the capital gain be waived off by like-kind transaction? So, okay, that's different. But today, in today's class, we're just going to focus on section 121, which says if there is a sale of principal residence. Okay, principal residence meaning the place, the house where the taxpayer is staying. So the entire exclusion amount, entire gain up to $500,000 can be waived off. And that's a very big number. And that's again very, very popular, exemption. A lot of people avail that, and it makes a big difference on their tax liability. Okay, so let's go over. There are certain conditions for it. Any kind of benefit given, we have to go through what are the rules, what are the conditions, what needs to be satisfied in order to take that advantage. So today class, we are just going to focus on sale of principal residence. Anytime we are doing a tax return, and if the taxpayer, if the client comes and tells us, well, I sold off my house, we should immediately ask, okay, so was that your personal residence? Was that your principal residence? Or was that your rental property? Or maybe just another property, but not principal residence. Because it's quite possible if it's principal residence, then even if the gain is up to $500,000, they may probably end up paying nothing, which is like saving of almost $100,000 or more, even if you go with the capital gain rates. And this is again a kind of incentive given by US government, because this is sale of principal residence. It's your personal property. It's not a business property. Anytime people want to buy their personal house or their principal residence, there are always benefits given, because again, this is one of the basic needs, right? Everybody should have their own house and all. So that's what government wants to encourage. And when they're selling off for some reason, maybe to get into a bigger house or for some other reason which are not so good, even on those kind of situation, the idea is that there should not be a huge tax liability impacting the residents. Because this house was never a business property. It was not a rental property. It was not a business property. It was not giving them any returns. It was just something that they were staying in. So they should not be charged tax, at least up to a reasonable amount. Obviously, if the gains are very high, $1 million, $2 million and all, then, that means that, it's not, it's much higher the limit, and that's why it's just fair that government also gets a share of that. Okay, so let's go over. Generally, a taxpayer recognizes a gain when the fair market value is greater than the basis of the property given up. This is just a general rule. Everybody knows whatever the fair market value of something that we get in return of our property, that is going to be the gains. Right? What is the basis in our books? What is that we are receiving back, either in terms of cash or in terms of some other property, or in terms of, maybe assumption of liabilities, something else. But we always have to see what is the fair market value, and that will become the gain. But there might be some situations where there could be a non-recognition of gain or loss. This could be temporary non-recognition, meaning we are just deferring it. Meaning we are doing a transaction in a way that instead of paying tax now, we will pay it later some point of time. And that will be covered in like-kind exchanges. It is deferral of gain. We are just pushing it out. We are not getting away from it. It's just deferring it. And there can be some permanent non-recognition, permanent savings, as in the exclusion of the gain on sale of a principal residence. So let's see section 121. It is very important. And whenever we come across that situation, we will go to form 8949, go to the input, put in there what is the property that you're selling off. There is a proper tab, there is a proper section if this is sale of a principal residence property. Then you have to go there and put all the information, like when was it bought, when was it sold, for how many years taxpayer was residing, what is the basis, what are the selling expenses, if any, or any kind of adjustments to the basis, like if we are renovating the house, putting up a new roof, or extending, maybe by adding one more room or something. Okay, were there any gaps in between? Is it it's quite possible that the principal taxpayer moves out of the house for a year or two and again moves back into the same house and makes that as principal residence. We have to consider those gaps also in order to calculate if they are eligible for full $500,000 benefit. Okay, so let's go over that. Section 121, this is important, provides an exclusion upon the sale of principal residence. Yes, and obviously no loss may be recognized on the sale of personal residence. There's no loss that you can take, but then definitely the gain is also exempt up to a certain level. Ownership and occupancy, this exclusion is available if the individual owned and occupied the residence for an aggregate of at least 2 of the 5 years before the sale. Before the sale, at least 2 of the 5 years, because they cannot put in the condition that, or it will not be practical if they put in the condition that as soon as you move out of the house, within 30 days, 60 days, 180 days, or within a year, you have to sell the house in order to get that benefit. It's quite possible that you're not able to sell the house right away and you'll put it up on rent, or I mean, it may take some time and all. So there's enough time that IRS is giving. They're saying just aggregate 2 years you need to stay in the period of 5 years from the date of the sale, going back. Non-qualified use requires the gain to be reduced. What is non-qualified use? Any use which is not for the purpose of principal residence. That could be non-qualified use. Maybe we are putting it up on rent for some time, make it as a rental property, we move out, maybe a taxpayer got a job in some other city, maybe he or she moved out for a year or two and then again came back, so up to for that time maybe the property was put up for rent. Any use which is not sufficing the condition of it being called a principal residence will be considered as a non-qualified use. This exclusion may be used only once every 2 years. Now, if you notice, every 2 years, like, I mean, this is a big amount. If you really plan it properly, the time period given is very less, which is really good for the taxpayers. IRS is saying you can use that exclusion once every 2 years. Just have to wait for 2 years. Okay, so I mean, and a lot of people take advantage of that. They'll probably make other places their principal residence. Just the gap is only 2 years. So just wait for 2 or 3 years and again sell it off. And especially this is very helpful if the markets are rising. Every few years, if you're making $100,000, $200,000 and not paying any tax on it, that's great. Okay, what is the exclusion amount? 250,000 for single, 500,000 for married filing jointly. And married filing jointly, either spouse meets the ownership test. It's not like both the property has to be registered in both the spouse name, because it's a married filing joint return. Maybe on records only husband is the owner or only wife is the owner of the house, but they can still take full benefit. Either spouse can be the owner. It's not like both their names have to be there as owners. Both spouse meet the use test. Both of them need to be staying there in that house, and that should be their principal residence. Obviously they can go out on vacation, or they'll probably go out for like a bit more than just vacation, maybe a month or 2 or 3, I mean, for some things, but then coming back. The whole idea is that the principal residence. And there are different ways to prove that. It's not that 24-hour you need to stay in that house only. Right? So both, but the use test has to be there. Neither spouse is ineligible for the exclusion. I mean, neither of the spouse should be ineligible because they have taken this exclusion within the last 2 years. A surviving spouse, maybe like a widow or widower, can qualify for the exclusion if the residence is sold within 2 years of the spouse's death. Okay, within 2 years if you're selling, because again this is a special situation. So IRS is a bit sensitive about it. That it's okay, because of the death, if the spouse is not living there, still same benefit will be given, but not for indefinite period. Within 2 years it needs to be sold out. Otherwise, the benefit given will be only for 250,000, because 500,000 is for married filing jointly. But if one of the spouses has died, then it cannot be married filing jointly. So the exclusion is determined on an individual basis. So therefore, for married couples who do not share a principal residence, if that could be the situation that the couple is married but they are not living in the same house for job reasons or for some other reasons, but if they're still filing their joint returns, a 250,000 exclusion is available of each spouse principal residence. So maybe they are living separately, right? They're living in different houses for whatever reasons. But if they are deciding to file joint returns, then both of them can get up to $250,000 on their individual principal residences. Okay, if a single individual, if they're marrying a person who has already used it and all, then the $250,000 exclusion is already taken, then the other spouse, then that has to be adjusted and the other spouse will be using the remaining. Okay, any divorce transfer, if the property is transferred because of separation and all, you can still take advantage of section 121. The time during which the taxpayer spouse or former spouse owned the residence is added. So what is the time that they are saying? That any 2 out of 5 years, and they have to be the principal. It has to be a principal residence. So even if because of the divorce also, if they're separating and all, but we can go back and we can count the time prior to the separation as well, in order to satisfy the other condition. Okay, widowed taxpayer, we've already seen that includes, I mean, even for widowed taxpayer, it will include the time period during which the deceased spouse also owned the residence. Physically or mentally incapable individuals, so if they are out because of some other medical conditions, maybe they have to live in hospital, maybe it's like a long, some kind of critical illness and all, and the person has to stay in a rehab center or in a hospital or somewhere else, or in some other center for the treatment, then obviously that house will not be considered as principal residence. And they said, IRS is saying that at least 1 year during the 5 year, if you are using it, even that is okay. If an individual is if a single person is eligible for $250,000, and if he is not completely stayed for 2 years in last 5 years, then for whatever time they have stayed, we will take that time period and we will prorate the exclusion. So instead of 250,000, maybe person ends up getting 100,000, 150,000, or 200,000. But it does not mean that the entire exclusion has been cancelled. We can always prorate it. So the exclusion is based on the ratio of months used to 24 months and all, and we can take the ratio for 24 months because 2 year is the condition given. Can someone read this, Muskan 11.1?
A taxpayer purchased and moved into a house, then 18 months later he sold the residence because of a change of job location. He must prepare any gain exclusion by 1824. The number of months the number of months used as a principal residence to 24 months.
Correct. So one of the things that I forgot to mention here is the pro rata exclusion is allowed only if the sale is due to change in the place of employment, health, or unforeseen circumstances. We cannot just say, oh, I don't feel like staying here, so I'm going to go and live in some other house, but I still want to take the exclusion. It's only if there are certain reasons which are compelling reasons, which are like, all valid reasons, because of that you're moving out, then you can prorate it. Okay, so here what they're saying is 24, he should have stayed for full 24 months, but within 18 months, he has to, sell the residence. And then because of the change in job or some other reason, which is allowed here. So all the gains must be prorated using this ratio. Okay, because the total, he can claim total exemption, he can claim total exclusion, which is 250,000, given if this taxpayer is single. So if he has stayed in the house for full 2 years, he can get full 250,000 exclusion. Okay, so we will use this ratio. Why 18 months? Because obviously after 18 months, the person has to go out. And this is a valid reason. Non-qualified use, we'll just go through one of the example. What is the non-qualified use? This could be a bit confusing, but what we need to understand, let's go over this point. Non-qualified use includes periods that the residence was not used as the principal residence of the taxpayer prior to the last day the homeowner lived in the house. What was the last day the homeowner lived in the house? We have to see that. And before that, what were the non-qualified use? We'll just go over this point also, then we'll look into the example. Periods when the residence was not used as a principal residence occurring after the last date the property was used as a principal residence are not counted as non-qualified use. Meaning, if the person has moved out, okay, if the person has moved out and then the property was put up on rent, obviously that's non-qualified use because the person is not using it as a principal residence. But for the purpose of calculating this exclusion, we will not consider that period as non-qualified use. Why? Because the person has moved out, the person may take up to a couple years to sell off the property. It's not an easy task. It's not just going and selling off your car or bike and all. It's a property. So it may take more time to sell it off. So we will not count that as non-qualified use. The provision does not penalize a taxpayer who moves out of the principal residence and then rents it short term prior to selling. It's quite common, that's practical, that they may, it's not like the day the person moves out, next day they'll be buyer ready and they'll buy the house. And this rule is also designed to prevent a landlord from moving into rental property for 2 years. What would the landlord do? Every 2 years they'll keep moving into rental property, make it as personal residence, sell it off, and then want to claim exclusion. There are ways people can play around with this rule and try to claim as much gains as possible. So again, we'll go over some examples and it will be more clear then. Okay, Vandana 11.2.
Okay, ma'am. During the 5 years prior to the sale of the house, the taxpayer lived in the house for years 1, 2, and 4. The
Okay,
absence.
let's pay attention here. During the 5 years, this is fine. We have to see the 5 years. What happened in last 5 years before the sale? The taxpayer lived in the house for 1, 2, and 4. The taxpayer has not continuously lived 1, 2, 3, and then he vacated the house. Maybe third year went somewhere out. Okay, and the fourth year came back and lived in his house. Okay, go ahead.
The absence during the third year is non-qualified use, causing a reduction prorated based on 1 year of non-qualified use in the allowed exclusion.
because this is happening in between 1, 2, and 3rd year. He's absent. 4th year he comes back. 5th year is not there. After the last day, once he moves out, he should not be coming back to live in that house. If he does that, then that will be the in between year will be considered as non-qualified use. But if he just moves out and does not come back, then we will not consider that as non-qualified use. So here, periods when the residence was not used as a principal residence occurring after the last day the property was used as a principal residence are now not counted as non-qualified use. But here, this guy is coming back and staying again for the 4th year, then moving out again in 5th year. So we'll have to consider what happened to 1 year in between that was a non-qualified use. We'll have to take that into account. So that will cause a reduction in the allowed exclusion. Continue, Vanna.
The absence during the 5th year does not affect the allowed exclusion since the taxpayer did not return to live in the house prior to the sale. Therefore, only $200,000 of the $250,000 exclusion is available. 250,000 into 4 by 5.
Yeah, so 250,000, you can say that this is for the period of 5 years because that's what the rule is, that any time during the last 5 years, the person has to stay for 2 years. Right? That's what the rule is. But there should not be temporary absences in between. If it's a permanent move out, it's fine. But here that was not a permanent move out. Only 1 year for 1 year he has moved out, then he came back again. So in this case, we have to give some consideration for the non-qualified use. So what IRS is saying that absence during 5th year is fine. Okay, why it is fine? Because he's not returning back. Once he vacated the house in 5th year, he's going out and he's selling it off. He's not coming back and staying in the same house. But absence during 3rd year is not fine. So if from 5 years, if we go back from 5th year, we see what has happened in last 5 years, then 1 year will not be taken as a qualified use. So the total exclusion, if it was available as $250,000, it will be prorated for 4 years. 250,000 times 4 by 5. And he can get the maximum exclusion of only $200,000. Is it clear to all?
Yes.
I hope no confusion. Okay.
Sale of principal residence exclusion. Sharon purchased a rental house on January 1st, 2017 as her personal residence for 3 years and then rented the house for 2 years before selling it on January 1, 2022. The time the residence was not used as a principal residence is un, not considered non-qualified use.
So that was considered as non-qualified use.
Non-qualified.
Right. Here, it is not considered as non-qualified because the person has gone out of the house and then it has been put up for the sale. So basically, what we need to do is maybe like think about it that way. The clock starts again. Right? If you have to see what happened in last 5 years, and if there are temporary absences and all, like the person is returning back, then we have to, recount the number of years. But here in this case, this is not qualified.
Mary purchased a rental house on Jan 1, 2017. She rented the house for 3 years and then made it her principal residence for 2 years before selling it on Jan 2022. The time the residence was not used as a principal residence before the last date the property was used as a principal residence is non-qualified use and reduces the amount of gain eligible for exclusion. Thus, only 40%, that is 2 years divided by 5 years, of the gain is eligible for the exclusion.
And she's thinking that in last 5 years, I've stayed for 2 years, so that should qualify. I should be able to take full exclusion. But that will not be the case, right? Because it was used as a rental property. And after that, she moved in. If she moves out and then if that property has been put up for rental purpose, then it's fine. Right? This is what has happened here. No, not here. Sorry. Some other example. If you see, if the person is stayed for like 3 years or 4 years, and then they moved out, and then the property has been put up for rent, and then if we see what happened in last 5 years, we'll see that okay, last 5 years after the person moved out, the property has been put up on rent. But before that, it was the principal residence. It was the residence for more than 2 years. The full exclusion should be given. Members of the military are allowed up to 10 years suspension, and also members of the military, they basically they get more time because military people have been like posted at somewhere uh, in the on the borders or some war zone and all, and it's quite possible for many years they're not able to come back to their home. So there's a bit of relaxation for them. So instead of 5 year rule, they've been given 10-year suspension also. So together it could be a 15-year period. They don't have a regular job like other civilians, right? So they're all military people. They may not be able to come. If there's an emergency situation, they may get stuck for many years, and which has happened. Like there were American soldiers in Iraq for many, many years, for 10 years and all, maybe in Taiwan and all. They were like, they just came home to visit and they again went back to those countries. Okay, so let's continue. What is the principal residence requirement? Section 121 excludes the gain on the sale of principal residence only. We need to remember that it cannot be used for other property. Gain may need to be recognized on the portion of the property that is not considered a principal residence. Now, if it's possible that we have a house, one portion of the house has been put up on rent, and or it's a duplex, half of the house has been rented and other half is used as principal residence, or some other way, whatever you're doing, then we need to like prorate that. We need to uh, take that into consideration that it was not 100% principal residence property. A portion of that was used for generating income. So that could become a business property. And if that becomes a business property, does anyone remember what is the form that we use? Sale of business property. Quick,
4797.
perfect. Yes, 4797. This is the form 4797. Then we may have to report the gains on this form. The recapture may come to the picture. There might be ordinary gains, there might be capital gains, and all those like complexities may come up, which we have seen in previous chapters. Okay, so what are they saying? Realized gains may qualify for exclusion. Okay. Realized gains may qualify for exclusion even though the entire property is used as rental or business property. Again, that's an exception. Let's see. The entire property is subject to gain exclusion as long as the individual owned and occupied the entire residence for at least 2 of the 5 years. Okay, this is the same situation that the person has moved out after that it was put up on rent. So again, this is very, very important because we have a lot of expat clients. We have a lot of clients, those who move from US to India, and then they tell us that okay, we have still left our home there, we have not sold it, but we want to sell it off. And this is a very good example how we can do some proper tax planning and give them the dates that see if you're planning to sell it off. First of all, do you satisfy the condition? Have you stayed in that house long enough to be considered as your principal residence for the purpose of Section 121? And it's just 2 years that we are talking about, right? So if they say yes, then we have to give them the date that okay, if they are moving out now, how many years can you wait? And and then if you sell it at the proper time, maybe entire gains can be waived. But once it becomes a rental property, once you cross that 5 year time period, there cannot be anything which can be done. This is a big waiver and you may lose it. So either you sell it within 5 year that time period, or you just leave it for like a long term thing, maybe 10, 15, 20 years. Use that property as an investment property. But if the plan is to sell off, then you better do it in within that 5 year time period. Why do it in 6th year, 7th year, 8th year, and then pay huge gains? We should be knowing about all these rules, then only we can, right, give proper advice. Again, these are all general stuff. Deduction other than depreciation, uh, that relates solely to the rental or business use portion do not reduce the basis of principal residence portion. Obviously, like we'll have to prorate it, we'll have to bifurcate what is the principal use, principal residence use, what is business use, how the deductions are applied to both different properties, maybe the same property but two different sections. Any selling expenses, we have to reduce it. Any gain, sorry, any gain equal to depreciation allowable may not be excluded and all. Any capital improvements have to be considered as an adjustment to the basis. And at the end of it, everything should be reported on schedule D. Even if there are no gains, we still need to put in all the information. Maybe on the face of it you'll say, well, the person bought the property for $500,000, sold it for $800,000, the gains are 300,000, all conditions are satisfied, 2 out of 5 years and all those things, there's no gain at all. So we cannot still go ahead and tell the client that okay, nothing you need to report, because a 1042S might have been issued. Sorry. We still have to report all of that. It's different that this gain may not come in schedule D as capital gain. Basis in a new home is its cost and all that we all know. Okay. If the resident was acquired in section 1031 like kind exchange, what is like kind exchange? It's a kind of exchange of a property. You're selling of something, you're buying it back again. So in that process, you can get some relief on the capital gains. So if you have already got that relief, what IRS is saying, you cannot take the benefit of both the sections. If you have already taken section 1031 relief, it was not recognized in the prior 5 years, then 121 exclusion for gain on sale or exchange of a principal residence does not apply. So we have to see, it should not, because it's the same property, right? The same property cannot take the tax benefits 2 times. If something was already taken up in the past, we need to see whether 121 can be taken again or not. Reporting, if the amount of realized gain is less than whatever maximum exclusion amount, gain need not be reported, but still, if the 1042S form has been issued and there might be a lot of information that has been already given to IRS, we should still do all the calculations and file it with IRS, and it's quite possible that Schedule D will not report any gains. Okay, so we'll stop here now.